Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There's just an hour to go until the closing bell, and stocks are coming off session lows here, following those fresh records on Thursday. The Dow slipping nearly 200 points, while the S&P 500 and the Nasdaq trimming gains to hover near those records. The slide coming as President Trump is reportedly pushing for a higher blanket tariff on imports from the EU. Financial Times reporting that Trump wants a minimum of a 15 to 20% tariff on EU goods as part of any deal. Just moments ago, President Trump saying he will be signing that landmark Genius Act to regulate cryptocurrency. It's the first major crypto legislation passed by Congress into law. For more on what that means for the crypto market later in the hour. Let's get you caught up on today's market action. Yahoo Finance's Jared Blickery standing by with more. Jared.
Thank you, Josh. As you said, we are experiencing just a tiny bit of downside in the markets. Dow down 175 points, about 0.4%. Here's the Nasdaq. It's been leading all week. It's just barely down. And let's check out the small caps as well. And then we'll go to the S&P 500. Russell 2000 underwater by 0.6%. And here's the S&P. It is just slightly down about 4 points there. Here's the intraday price action. We actually gapped up to a record high on the open there, but then we drifted into negative territory. I'll tell you what, these tariff headlines don't have the kick they once did. So this is a very muted reaction given the weight of these potential tariffs that we're seeing right now. And let's take a look at the VIX, because this has been down this week, up just a little bit, but 16.62. That's pretty close to the lows that we were seeing earlier in this year when we were at record highs back then as well. And here's the 10-year T-note yield. Off of that 4.5% mark that we saw earlier in the week, it's down about 3 basis points today. 30-year critically still at 5%, but it was as high as maybe 7-8 basis points higher a few days ago. And we'll just check out that 5-day chart real quickly. That was that Fed commentary right in here. We're going to be talking about that for sure in a few minutes. Finally, here's the U.S. dollar index over 5 days, down slightly today, up just a little bit for the week. So nothing to write home about there. And let's check out the sector action. And this is the Nasdaq. We'll go back to that in a second. Here's the sector action. Utilities leading the day. You don't see that by too often and by such a high margin, but it is up 1.75%. After that, you have consumer discretionary, thanks to Tesla flying high today. Then you have real estate and financials. That rounds out the winners. We also have materials and financials outperforming. To the downside, energy has had a bit of a tough time this week with crude oil under pressure. It is down 1%. Communication services down 0.7%. And we'll take a quick look at the Nasdaq here. You can see kind of a mixed board for the mega caps. Nvidia coming off a record high, that's down 0.5%. But as I said, Tesla screaming higher, that is up 3%. And we'll take a look at the Dow here, and we can see kind of a mixed board as well. Some of the names that are leading to the downside: AXP, American Express, down 2%, Chevron down almost 3%, Coca-Cola, a staples company, down about 0.2%, and IBM, that is up 1.35%. It's been hitting record highs recently, and I'm going to close on this. We don't usually see the utilities board light up, but this is a sea of green today, so I thought we'd show it anyway. Most of these tickers, everything except CIG in the green. And on that note, I will send it back to you, Josh.
All right, Jared. Well, let's kick it out right now to Yahoo Finance's Jennifer Schonberger, who is with Chicago Fed President Austan Goolsbee. Jen.
Thank you, Josh. And Austin, thank you so much for joining me. It's great to see you and have you back on Yahoo Finance on this last Friday before your blackout period.
Yeah, thanks for having me back, Jen.
So
That's
I want to kick off sorry, what were you going to say? I want to kick off the conversation with the fact that the Fed
I just said thank you for having me on. Yeah.
Great to have you. I want to kick off the conversation with the fact that the Fed has been waiting to see what the impact of tariffs will be on inflation over the summer months before charting a course forward on interest rates. And we got the first reading of that this week with the June CPI. We saw that tick up 0.1 percentage point to 2.9%. That was up from 2.8% previously. Are you seeing any indication that tariffs are pushing up inflation now?
I think you saw it on goods. If you look at the core goods inflation, especially in some of the heavily imported stuff, you were getting a warning sign. I took some encouragement that the services and the housing parts of core inflation still remaining pretty tame. But to me, that all fits into the space of still wait and see what is to come. And it doesn't help that we're going to announce a new round of tariffs that are going to apply to domestic production, parts, components, copper, supplies. We're going to go back and revisit tariffs on Canada, tariffs on Europe. There is a sense in which we need some resolution that we can count on before we can fully understand what the impact of this is.
How does that new round of tariffs that have been announced, and we've seen the president send out letters stipulating what tariff rates could be. Of course, we could see some negotiations, but those tariff rates are anywhere from 20% to 50% on some of our largest trading partners. How does that change your outlook for inflation?
I mean, that's the dual problem is if we're making these announcements in a kind of a drip fashion, you can't just count on let's call it the economic theory of tariffs. Hey, it's a one-time increase in the price level. That's a transitory inflation shock that a central bank doesn't have to worry about. You can't really make that argument if it's not a one-time increase in the price level. That said, as I've been emphasizing, imported goods, which these tariff taxes apply to, are only 11% of GDP. So there is a sense in which if it will stay in the 11% lane, it doesn't have to have a big material impact on inflation overall. And what you're going to be nervous about are if the tariff announcements lead people to freak out and change their behavior, that jumps it out of its 11% lane. If you start applying them more and more to intermediate goods like parts and supplies and components, then it's raising domestic costs of production and it gets out of the 11% lane. Or if there's big retaliation, then again, it's getting out of its lane. We were getting some relief on all three of those fronts as we got some exceptions and where they were backing down and doing the negotiations. And I think we just have to hope that we back down on all three of those fronts again, because right now we're kind of ramping up on all three.
Yeah, Austin, you had said that the central bank could cut rates if we saw what you called, quote unquote, dirt come out of the air. Now that we're seeing more uncertainty and an increase perhaps on these tariff rates, is this more dirt or, if you will, mud being slung? Does this prolong the timetable to wait and see what to do with interest rates? Has this changed your timetable at all on interest rates and cutting rates?
I feel like it started as dust in the air, moved to dirt in the air. Now I'm going to have to start thinking about, is there such a thing as mud in the air? Or if the mud is in the air as it is getting on us? I think anything that makes it harder to figure out if we are on a path back to 2% inflation, anything like that is extending the timetable of when the rate cuts can happen. As you said, I have been of the view that before April 2nd, before Liberation Day, the dual mandate grounds of the Fed of just price stability and maximizing employment were looking pretty good. And it looked to me like we could afford to start cutting rates, and that rates, I was saying then 12 to 18 months from then could be a fair bit below where they were. Now, it's been 3-4 months, so now maybe we're 9 to 15 months away. I still think if we can get that uncertainty out of there and we aren't off the path, if we are still on the way to 2% inflation, rates can come down. But we don't know if we're on the path to 2% inflation because we don't know on tariffs, on energy prices and geopolitics, and in a few different areas. We don't know until we know. We're going to have to wait and see what's happening in the data. If we get multiple more months of benign readings on inflation, I would be feeling more comfortable. If we start to see a ramp up on prices coupled with a ramp up and increasing the tariff rates, then we're going to just have to see how big an impact that has.
Given where we stand right now, though, Austin, do you still think that rate cuts are on the table in maybe the fall months of this year? Or are you looking more in sort of a hold pattern right now?
Well, Jen, I always say, I don't like tying our hands ahead of the meetings. I want to hear what my colleagues around the table have to say. I want to see all the data that come in between now and then. But it's the biggest table literally I've ever seen in my life there. You've seen it. And so everything is always on the table. I have no problem. And as I say, if we can get the dirt out of the air and it shows we're still on path back to 2% inflation, then I think for sure it's realistic that rates could come down. It's just that if it gets cloudier and cloudier, so you can't tell whether you're on that 2% rate, that's to me is a recipe for waiting.
The Fed Governor Waller has said he's concerned about the job market, saying that only 74,000 private sector jobs were created last month. He called that stall speed. And he wants to cut rates on July 30th. I'm curious for your thoughts on that and whether you share his views on the job market.
Well, you know the rules of the FOMC. I express only views myself. I don't weigh in on what other people think or what the committee thinks. That said, just looking at the total net job creation for the month, we saw last year when there are big changes to the amount of immigration, that can be an unreliable indicator. We need to think seriously about what's the break-even level of employment. I do still have concerns about the job market side. And if we were to start seeing, for example, significant layoffs, when the business cycle normally turns to recession, you start to see layoffs increasing. You start to see the unemployment rate going up at a not small clip. If we start seeing deterioration of the labor market, then that would be a major factor in my thinking.
The president's allies and advisors have been trying to paint Fed Chair Jay Powell's comments to Congress on renovations of the Federal Reserve's headquarters and buildings here in Washington as untruthful as they try to push him out because he hasn't been cutting interest rates. The president himself told reporters this is sort of a fireable offense, only to turn around and say that he has no intention of firing the Fed chair. We've heard from CEOs of major banks like JP Morgan and Goldman Sachs who've said the independence of the Federal Reserve is absolutely critical. Playing around with the Fed could often lead to adverse consequences. Is this campaign undermining the credibility of Fed Chair Jay Powell and the institution of the Federal Reserve and public support for the Federal Reserve? Do you worry that this is damaging and a potential threat to Fed independence?
Look, Jay Powell's a friend of mine. He's a totally honorable guy, and I'm a big admirer of his as the Fed chair. I think he's a first ballot Hall of Famer. I'm not going to get into the politics. I'll just say I've been in the Fed for 2.5 years. Before I ever got to the Fed, I, as well as a virtual unanimity of economists, believe that central bank independence from political interference is absolutely critical to the operation of the Fed and of the economy. That if you just look at places where they do not have independence for the central bank, inflation is higher, growth is worse, unemployment and the job market do worse. And everyone knows that. That's why every rich country of the world has an independent central bank. And as I say, it pains me to hear people actively discussing whether the central bank should be independent. I think there's nothing good can come of discussion like that.
Austin, we'll leave the conversation there, but thank you so much, as always, for your insight. I so appreciate it. Look forward to talking with you again soon.
Great to see you again. Thank you for having me.
Josh, I'll send it back to you in New York.
All right, thank you, Jen. And to continue the Fed conversation, let's get to Prairie operating EVP market strategy and the BigSkinny.com founder Lou Bassin, and bringing back in Yahoo Finance's very own Jared Blickery. Lou, I will start with you. Some interesting back and forth there. I think we'll start with the tariff inflation impact. June CPI ticking up. Austan Goolsbee telling us that was a warning sign, he said. Took some encouragement that services were maintained, but still wait and see, he says, Lou. Doesn't help. We're announcing, he pointed out, a new round of tariffs. He mentioned copper, revisiting tariffs on Canada and Europe. He said we need resolution before fully understanding that tariff impact. What'd you make of those comments?
Yeah, there's a lot of moving parts, right, that they're trying to figure out, and I think that's the important thing. He did allude to the fact pre-tariffs that they were on a path. The trajectory of inflation was to cutting rates, and now that's just gotten confused by, he called it dust picking up in the air. Look, I look at it this way. He pointed out a key data point. Imported goods are only 11% of GDP. So you're seeing there's this trickle-down effect that we're not exactly sure how the end consumer is going to face the tariff increases. And we saw it even in the Fed's beige book that not all companies are passing the costs on directly. I think of it like food. You know, farm to table means there's no intermediaries. When it comes to tariffs, there's tons of people in the supply chain that have an opportunity to absorb some of that cost, and we're seeing that happening. So I really think this is a difficult situation where the Fed has got to be in the position to try and divine the trajectory before they actually have clarity. Otherwise, they're going to be too late.
And Jared, on the subject of cuts, my friend, the timetable there, that came up. Austan Goolsbee telling us anything that makes it harder to figure out if we are headed back to 2% is extending the timetable of when cuts can happen. He went on to say if we can get uncertainty out of there and we are still on the way back to 2%, rates can come down, but we don't know, he said. We need to watch the data. Your thoughts?
Yes, uncertainty is going to be around for a while. That's my thought there. I don't see it going away anytime soon, but we will learn some more off after August 1st, and we keep kind of kicking this football. Well, we got to take a look at the next month's CPI. We got to take a look at the next month's jobs report in certain instances. Nevertheless, the market is still pricing in two Fed cuts, so 25 basis points apiece, or 0.5% total, by the end of the year. So that's into that December meeting. There are a few markets I'm watching here, and this is a longer term market. This is 30-year Treasury bond yields, and I'm going to show you a one-year chart here. It's been knocking up against 5% several times over the last year, and every time it has, it's rolled over, but you can see it has not rolled over just yet. And the last time, and this happened earlier this week on some of those Fed headlines where Trump was going to fire Powell, potentially, we saw it tick up quite a bit here, and we saw risk markets tip over. We saw stocks sell off there. So I think that's a key consideration for what's going on here. Now, the Treasury can have some maneuvering room. Bassin over there can keep the 30-year yield below 5% by doing some technical things, and beyond the scope of this conversation to do that. But what's the relief valve? Typically, it is commodities and the dollar. And the dollar here, this is a US dollar index chart. I'm going to put a 1 year. We have seen this trending down for the most part. It ticked up over the last few weeks, but this is definitely a downtrend since the beginning of the year. And if it keeps going down, that's just going to juice risk assets even more. And even if it goes up, that just means the commodities are going to be that release valve. This is a year to date of the commodities heat map that I have here. Platinum is up 60%, palladium up 40%, copper up 40%, silver 30%. So we've seen a tremendous amount of money flow into commodities as kind of this safety relief system. And I tie it all together with the fact that the Fed is not even considering hiking. If anything, they are going to be lowering rates. And that's really the key consideration for me.
All right. Meanwhile, President Trump, he is just signing the Genius Act into law. He's speaking now live at the White House. Let's take a listen.
And, make $79,000 commission on the sale of a sock, right? It's true. But I want to ask David. So David's been fantastic. He's done an incredible job. And I'd like to ask David to come up, say a few words. Thank you very much.
Thank you so much. All right, thank you, President Trump. It's a great honor to be here, and it's true that I never expected to work in government at all, and then everything changed after President Trump came on my podcast, and I accepted this job as crypto czar because I thought it was a once-in-a-lifetime opportunity to work for a president who really wants to get things done for the American people, and if anything, that's been an understatement. The first 6 months of this administration have been more successful than any administration in American history. What's been done? It's just been incredible. President Trump has worked at tech speed. We're used to working fast in Silicon Valley, but even this is fast for us in Silicon Valley, the speed at which you move, President Trump. It's really incredible. And now today, you have another historic legislative achievement that is a monumental step to fulfilling your promise to making the United States the crypto capital of the world. This Genius Act will unlock American dominance in the crypto industry by creating clear rules of the road. It will update archaic payment rails with a revolutionary new payment system, and it will extend U.S. dollar dominance, like you said, globally, by creating a digital dollar that people all over the world can use. And for every digital dollar in a crypto wallet, there'll be a traditional dollar in a U.S. bank account, which will create trillions of dollars of demand for U.S. treasuries. So that is the power of this bill, is U.S. dollar dominance. This is a huge promise made and promise kept by President Trump. And there's just a few other people I'd like to thank. First, my family for being here. Thank you. And Bo Hines, who President Trump mentions, the director of our crypto council, he really did the heavy lifting here. So, Bo, I just want to thank you again. And my chief of staff, Tracy Johnson, as well, who also does the heavy lifting. And Bill Hagerty and French Hill and all the congressmen and senators who have already been mentioned by President Trump, so I'll save the time, but it was really been an honor to work with all of you. This was really a team effort, but most of all—
David Hollerith is here for a look at the implications for the broader crypto industry. David, great to see you. Let's start with implications for stablecoins. As an industry, David, how do you think about the possible adoption curve here? Because some of the numbers that are thrown out, it's impressive, right? You got our own Treasury Secretary, Bassin. He believes dollar-linked stablecoins, he says, could reach $2 trillion or more in market capitalization. But how do you see the adoption curve from here?
Yeah, well, Josh, there's even a higher estimate out there by Citigroup that says $3.7 trillion, which is interesting because the actual size of the total stablecoin market at this moment is about a quarter smaller than Fidelity's government money market fund. So that gives you a perspective about where we are with this. But the actual implications of what this legislation does is pretty broad in that it basically opens season for banks, large retailers, fintech firms, anybody to basically issue stable coins. And allowing that is going to be able to open up the ecosystem in a bigger way. Now, the main use case being looked at that banks are talking about is sort of cross-border payments. And
they get faster, they get cheaper, right?
Yeah, exactly. And that makes a lot of sense for a big bank like Citigroup or JP Morgan Chase. It makes a little bit less sense for smaller banks and smaller companies, period. But when you begin to think about what else the Trump administration has in store and what the Congress might actually achieve, it begins to look more interesting. Like, for example, the SEC has been sort of gesturing towards considering ways to allow companies to tokenize stocks or bonds or securities. And so if you have an ecosystem where financial investors, retailers are just simply using the blockchain more often, this is how they would pay for things. So this is kind of the first step there. So it's actually pretty broad, but we honestly, admittedly, don't know what the adoption is going to be like, and it's definitely not going to be linear is what we're expecting.
Lou, I want to get your take. More broadly, it's a big moment for the crypto industry, right? And listen, a crypto lobby that has become much more powerful and influential. You own crypto. What do you own? Is it the tokens? Is it the ETF?
I just own in Coinbase. I'm a reluctant adopter of crypto, which I think is what's happening here. You're seeing.
Why do you say that? Why do you say
Because
reluctant?
I thought it was a fascination, right? At first, I would tell you that a limited supply of nothing, it can't be worth anything, right? But now you're trying to figure out it's being adopted. So I think this removed a key hurdle, and that's the decision of, is crypto a security or is it a commodity, right? The financial system was waiting for the all clear from the administration to say, hey, you can get into this and start this ecosystem and not worried about being regulated from behind. So I think this is a key moment that's going to digitize and bring the US into the modern age in terms of currency. A lot easier to do it now and innovate from the front than it is to kind of go back and let someone else maybe take the lead. But
I was asking Lou, some guys recently who are in this space, about the recent rally in Bitcoin. Get your thoughts. And I asked them what explains that, and they mentioned Crypto Week, but bottom line they said, Josh, do not overthink this. This is just strong corporate and institutional demand,
Yes.
limited supply, prices go up. It's that simple.
I agree with that, and I'd say the other thing is very interesting. If you price the price of Bitcoin next to the cost to mine the next incremental Bitcoin, it's almost perfectly correlated. So you would expect market price to be in line with how much it costs to get the next Bitcoin out. So those two factors, institutional demand, which seems unlimited. I can say from my own conversations, I'm on a board of a company that's considering a crypto treasury strategy. We're seeing strong institutional demand because it's a way to get liquidity in the form of equity as opposed to having to own the actual coins themselves.
There you go. David, by the way, great. Thank you so much for being on set with us. Appreciate it.
Absolutely.
We are just getting started here on Market Domination. Coming up, could Trump's tariff uncertainty create a stagflation environment for markets? I speak to a wealth advisor on their side who says signs could be pointing in that direction. Stick around. Much more Market Domination still to come. Stocks stalled out today as markets hover around record highs. Our next guest says there are some signs pointing to an upcoming stagflationary environment. Andrew Briggs, wealth manager at the Plaza Advisory Group at Stewart Partners, now with me. Andrew, it is good to see you. Actually, I want to start, Andrew, get your take on some more. We did get some more tariff headlines here, right? President Trump reportedly pushed it for 15 to 20% minimum tariff on all EU goods. This is per the FT. You know, broadly, Andrew, the markets have been willing to kind of shrug off these headlines. I'm just looking at the broad gauge. We're basically flat. I'm curious to get your take on the market response there.
Sure, thanks for having me. So, yes, I mean, they're obviously, as you mentioned, the ingredients for stagflation seem to be kind of rearing their head as far as inflation being elevated, or as we just saw in the CPI print, it's kind of starting to show its teeth through some of the good side. Obviously, what's this going to do to growth? Which the obvious answer would be at some point it should continue to slow it. Regarding your question on the continual announcements on the tariff front, our belief has still been, and this goes back to even Liberation Day, that it really is first and foremost a negotiating tactic. I think based off their move to put them off once they saw the Treasury spike, as well as some other measures as far as the impact on the large tech companies here, which control or dictate the performance of our market. I think the administration knows that the global world order, although they want to change it, there's only what pace or what speed can they do so without causing complete disruption.
Let me ask you, Andrew, I want to go back to that first point you were making there. These signs you're saying, suggesting maybe a stagflationary environment. Just walk me through those signs, Andrew. What data points specifically are you looking for?
Yeah, so actually, I would probably say, although they're looking like, those can be, like I said, ingredients for stagflation, I actually don't think on the inflation side of the equation, that's really going to happen. The issue is, I think from a tariff impacts endpoint on inflation, at worst case, it could be a one-time spike. But the question is, I know President Goolsbee was mentioning earlier, the majority of inflation still, so 60% of CPI, is still services oriented. A significant portion of that is shelter. If you get those starting to kind of alleviate and kind of come down a little bit, which certainly will offset the smaller proportion being good side, I think all you're really doing there is kind of reshuffling the deck as far as, maybe not changing the level of the water, but, just changing the constitution of that for whatnot. So as far as the data goes, like I said, obviously there was some upward pressure on goods prices within the CPI front. Kind of got that from retail sales as well earlier this week, how much of that was truly spending versus inflation. So, I don't think I think it's too soon to sound the alarm on stagflation. It's obviously a possibility, but we firmly believe that, that the long-term impact to inflation as of now doesn't look to be too extreme.
Lou, I want to get you in here today, get your take. We got a rush of economic data this week. I think broadly, Lou, it looked relatively solid, but what is your take?
Yeah, I'm with Andrew here that I don't think there's any immediate red flag that we got to freak out about, especially in regards to stagflation. I agree that the ingredients are there. I think they're in the store, but they're not in my shopping cart yet for stagflation. I look at one thing that's really counterbalancing all this data, and that is AI deflation, right? We're seeing some layoffs in the tech sector alone largely, and that I think is because of productivity gains. Any impact that we're going to see, or any major impact from inflation and tariffs, is going to be muted by AI deflation, in my opinion. So I'm not worried about stagflation. I think it's more about getting the timing right on the first cuts to keep the economy growing.
Andrew, we were talking economic data. We also got a rush of earnings this week. I'm just curious to get your thoughts. How would you so far generally characterize the earnings season?
Yeah, we're obviously, early on. Some of the big names are yet to come in the next, 14 days or so. Obviously, the bar was quite low, and they kept lowering second quarter earnings to, I think, finalized at 2.8% or so. So an extremely low bar, which obviously, as we've learned over history, is easier and easier to clear from that standpoint. But obviously, the banks, I think you guys were just discussing this, even on the crypto side. The big banks continue to be stronger, and where does that leave the small to mid-sized banks? So that's one interesting story I would take from the earnings thus far. But again, I think the interesting thing I will be watching as we get into next week and the following is when you get some of the Magnificent Seven to come out and report, is what they do say about the tariff front. Because frankly, when you're looking at, for instance, cost of goods sold, I believe the number is somewhere around 40% of their cost of goods sold. Is from international markets. So again, that's another reason, back to my earlier comment, where I would imagine the administration knows this. These are kind of the darlings, the top best companies in the world. I don't know how much they want to do to jeopardize that from that standpoint, which is why I think, again, there's potentially a limit on how much tariffs are going to impact that.
Andrew, thanks so much for your time today. Enjoy the weekend.
You guys too. Thank you.
Coming up, shares of American Express and 3M are sinking despite topping earnings expectations. Going to check in on some of today's top trending tickers later in the hour. Stick with us. Much more market domination. That's still to come. CBS announcing on Thursday that it will end its run on The Late Show with Stephen Colbert in May 2026. For more, we're bringing in now Alex Weprin, media and business writer at The Hollywood Reporter. Alex, it is great to see you. So let's dig into this, Alex. So Paramount decides they're going to cancel The Late Show with Stephen Colbert in late 2026. Immediately, of course, Alex, there's a lot of hot talk and a lot of hot takes about why this happened, as I'm sure you saw. Now, CBS is saying, Alex, not related to the show's performance. This was purely a financial decision, is what they told the Journal. What do you make of it?
I mean, look, the fact is the economics of late night TV have deteriorated over the last few years. I talked to a source who said that they don't think any of the current broadcast late night shows are actively profitable. The funny thing with CBS, The Late Show, it had higher ratings than Jimmy Kimmel on ABC and Jimmy Fallon on NBC. It had lower ad revenue than both of those shows. So I do think there is a financial argument to make here. Obviously, some people are speculating that it's connected to the pending Paramount Skydance deal. You can speculate about that, but there's really no denying that the economics of late night have changed a lot.
Alex, Puck News had some numbers around this, and they said, this impressed me, but you live in this world, Alex, so I just want to run these numbers by you. They said the show cost more than $100 million a year to produce, Alex. It was losing more than $40 million a year. I was impressed by those numbers. What do you think?
Well, I mean, think about it. Stephen Colbert, he's probably making low eight figures. They shoot in a midtown Manhattan theater that holds 400 seats. They have a staff of about 200 people. It's an expensive show. Like a lot of these traditional linear TV shows, they cost a lot of money. They cost more money than people think. And the truth is the economics of that just don't work anymore in a world where fewer and fewer people are watching. And you've got these upstart digital, programs that cost a fraction of that to make.
Alex, Rich Greenfield over at Lightshed, he was telling his clients this morning, he was like, listen, let's not lose sight of the bigger picture here. And what the bigger picture to him, Alex, was, he says that linear entertainment TV is dying, his words. And he went on to say, in fact, dying at a rapidly accelerating rate. He provides some data to buttress that point. Said consumers are now spending more time each day streaming TV than watching broadcast and cable TV combined. Would you agree with that take, though? Linear entertainment TV dying, and it's only dying at a quickening speed here.
I think Rich is broadly correct. People do watch news and sports on linear TV, but when it comes to entertainment, and that includes late night, includes like scripted dramas, it includes comedies, people are streaming those, and they're streaming them on demand whenever they want. On Netflix, they might be on Paramount Plus, people are watching on their own terms when it comes to entertainment. Really, news and sports are kind of the only things people are watching live on linear TV now. And the changes we're seeing at the Late Show are reflective of that.
Why would, this was a question that Rich asked, Alex, I'll pose to you. He asked, why would a legacy media company invest in original programming for linear TV at this point, outside sports and maybe to a lesser degree news?
So look, you're seeing these networks. NBC, for example, is adding the NBA this coming season. They're adding more and more live sports to their primetime lineups. So they are going to fill more of this space with sports and news. There will inevitably be some gaps there, and it makes sense to maybe develop some cost-effective entertainment programming that can fill the gap and eventually go on streaming. But you're going to see less and less of that over time. You're just going to see more news, more sports on linear, and there might be a little bit of entertainment to balance it out that people can also get on streaming. But the way that these companies are programming their linear television networks is changing.
Do you think, Alex, the Late Show is just the first? We're going to see a lot more linear TV personnel and programming get the axe here?
Yeah, I mean, look, people I've talked to in the late night space are kind of on edge right now. They do think that other shows will follow. It's hard to think that NBC would cancel the Tonight Show, but you never know. Broadly, we do expect more late night shows to eventually get the axe. Maybe not next week, maybe not even this year, but over the next couple of years, there's really no doubt about it.
Alex, great to see you and to have you on the show. Thank you, sir.
Thank you.
Now time for some of our top trending tickers. We're checking in on shares of Chevron and American Express. First up, shares of Chevron, they are lower despite the news that they can move forward with that $53 billion acquisition of Hess. It's coming after officials dismissed Exxon's attempt to block that deal. So Lou, this was a long time coming, we know. Yeah. Chevron wins this arbitration battle with Exxon, closes this mega $53 billion deal to buy Hess. Chevron CEO telling Bloomberg here, this creates a premier international and oil and gas company. What do you think? You agree?
I agree. I mean, I work for Prairie Operating Company. We're not as big as Chevron by any means, but this is a key thing. It removed some of the regulatory hurdles to more consolidation. It gave them a lot of reserves, about 180 billion plus worth of reserves. And I think this is why it might be selling off some weakness. There's about $1 billion in synergies and cost savings. I think the market wants to see that realized. But I would say, I mean, the energy sector as a whole is down so much. It's so underweighted in the S&P 500 that there's really very low risk, high possible return here as we see oil prices kind of find where they're going to stick. I think you need around 70 for a lot of these operators to be very profitable. And but long term, I think this is a really good trend for the industry.
All right, moving on. Next ticker, American Express. Those shares are sinking despite topping earnings expectations. The credit card company expenses of $12.9 billion were higher than expected in the second quarter. So Amex, yes, reports on expenses did grow in the second quarter, Lou. Consolidated expenses increased 14%. That was higher than expectations. It sounds like that was about, in part, investments in tech, risk management. Build business did top estimates. The CEO talking about here, record card member spending in the quarter, demand for premium products was strong. Credit performance, he says, best in class. We did see slip in there.
Yeah, I think people and investors are just worried about the consumer. When are they going to roll over, even if it's the high end of the consumer here? But I mean, you showed the numbers there. They blew out expectations on the bottom line. Strong revenue growth, almost double digits. Premium usage, no sign of weakness. I think everyone's just waiting for Godot here in terms of the consumer that's just going to struggle at some point. I just don't see it's going to happen, though.
All right. Well, coming up, here's another big name we're watching, Tesla, because those earnings are going to be in focus next week. We're joined by an analyst on their side to preview the results and tell you the best ways to be positioned in the auto sector. Stick around. Much more market domination. That's still to come. Tesla in focus as second quarter earnings are on deck. President Trump's big, beautiful bill shifting the landscape with tax credits getting phased out. We're navigating how to play the EV sector with the Yahoo Finance playbook. Joining me now is the one and only Tom Narayan, here in the flesh, lead equity analyst of global autos at RBC Capital Markets. Tom, great to see you, especially on set. Let's dig right in. Tesla earnings on deck. Your clients are asking you, what are we going to see? What are we going to hear? What are you telling them?
Yeah, I mean, there was a lot of negativity, right,
Yes.
in the past few months, I would say. But really, when you look at the numbers, the deliveries were actually all right. They actually beat buy-side expectations.
It was better than some feared, for sure.
Better
You
than
saw
a lot of
pop,
people
yeah.
feared.
Yeah.
And really people were thinking that there's this like backlash against deliveries, against Tesla, but if you really look in the numbers, that's not what's happened. Their performance in the US was very similar to China. They have some stale models. They're going to have a more affordable model supposedly
And what
coming
is
out.
that? What is that going to mean for growth? I mean, you got the revamped Model Y, the new affordable model. What does that mean for growth of the EV business there?
I think it's a big deal because there's this fear that there's this anti-Tesla kind of mythology, so to
Well,
speak.
Sheryl Crow's out there. You saw she's selling the Tesla. Come on, it was making headlines. But that was a thing. I mean, Tom, we talked a lot about it. I think we talked about you, whether there was this brand damage.
Yeah, and the reality is, people, when you really dissect the numbers, it wasn't just Tesla. The whole EV space in the US was down quite a bit in the second quarter. It's because there's such a glut of used EVs in the market. I mean, a lot of my friends ask me like, hey, what car should I buy? I'm like, you should buy a used EV right now. You can get some crazy discounts. That's what's pressuring the numbers.
Yeah.
And this affordable car, I mean, let's see if it's actually coming in the third quarter. That's kind of the expectation. That can reignite demand. As you know, this is a narrative stock, right? People look at deliveries and that's how the stock trades, even though we think it shouldn't. We think it's more about autonomy and robo-taxis and that sort of thing. But I actually do think if it does reaccelerate demand, you'll see the sentiment swing back in favor.
What did you make? While I have you, because you mentioned robo-taxis, the Uber-Lucid partnership, because you cover Lucid, get a sector perform. I want to get your thoughts on that partnership, and then I'm just curious, how do you think Tesla thought about that news?
Yeah, I mean, look, it's like 20,000 vehicles over 6 years. You know, Uber has relationships with lots of robotaxi companies, right? There's a relationship with Mobileye, which has the Volkswagen ID Buzz. So I think it's going to be one of many relationships. I think it's great for Lucid.
Yeah.
I think the stock was up like 40% or something like that. That has more to do with Lucid and issues that company has with the capital markets and its people think of its survivability, et cetera. I don't know if this phases Tesla. Tesla's model is very different, right? It's let's switch on every Tesla on the road with unsupervised FSD and everything's a robotaxi. So
how that's the ambition. How do you quickly, Tom, does that Tesla robo-taxi service, how quickly does it expand, in your opinion?
We have to see. I don't think it'll happen overnight, right? But theoretically, if every Tesla has unsupervised FSD with just cameras, and you could switch it on and you don't need LiDARs and radars, that's a game changer. So it's more theoretical. I don't know if we're going to get there just yet. We have to see. Early indications on the Austin service, you know, a lot of people were expecting a lot of accidents and a lot of negative news. We haven't really seen it. They're talking about expanding with California and maybe Phoenix. So indications so far are promising, but only time will tell.
But bottom line, heading into this print, you do maintain the outperform, correct?
Yeah, I think so. I think the expectations on the sell side numbers are pretty low. The margin number is not that much better than the first quarter, and the deliveries were a lot higher. I know the energy storage number wasn't that great, but they're going to get regulatory credits. I think there's a good chance that they'll beat. But investors I'm speaking with are already positioning. That's what the stock I think was up today. So, you know, when it reports, we'll see. The other thing to keep in mind is what always drives the stock on earnings is the conference call. Commentary on the call, on robotaxi, on this affordable car. These really will probably drive the stock more than just the print.
What do you think Musk is going to say about China on the call and how that business is going?
Yeah, that's a big topic. I actually think that they're pretty optimistic there. You know, the China situation is more because EVs are selling like crazy. The big losers there are more about companies selling ICEs there, right? The German OEMs are really losing share. Tesla's actually doing all right. I think it'll be pretty constructive, pretty positive there. You know, the worry is really more about Volkswagen. Those types of cars are losing share, not really Tesla.
Let's talk about another big topic, which is tariffs.
Yeah.
And I'm curious how the auto names, the names you cover, Tom, how are they navigating that dynamic?
Yeah, I think there's been a lot of optimism in recent months about a deal finally being struck. And I think you eventually do get a deal. Now, some people had hoped that it was June, July timeframe. Now it's looking like maybe August timeframe. They're talking about the EU potentially doing a deal. Remember the EU has this tariff of like 10% on U.S. Exports over there. The U.S. auto industry doesn't really export anything over there. It's actually European car companies that do it. It's just because we have the chicken tax, right? The SUVs and pickups. So it's more of a retaliatory thing. So what people are thinking now is that the Europeans may drop their 10% lower, and the U.S. administration gets a nice W by that, and then they can drop theirs, and that's probably indicative of what we could see from Korea, Japan, other countries. I don't know about China. That's a whole other topic. But I do think eventually, and that's what a lot of people are thinking, you'll get the deals struck. It's not a question of if, it's more about when. I think it's more like August, September timeframe.
Do you think, we know what the president wants. He's very clear about that. He wants everything made here. Do you think we would ever see, Tom, an American auto name say, okay, we are actually going to we're going to build a big new final assembly plant here in the United States? Do you think we're going to hear that?
No, I don't think that's eventually what's going to happen. I think on the margin, you'll get some more, right? Actually, Mercedes has already talked about expanding a new vehicle in the U.S. BMW's talked about expanding production by, I think, 50, 60,000 units at their facility in the U.S. It's happening on the margin. You're also going to help the U.S. supplier base. Maybe some of the Japanese OEMs may talk about maybe doing a lot more localizing here. USMCA could require U.S. contenting, which doesn't exist, which could require a little bit more U.S. content. So I think on the margin, it will increase U.S. productivity, U.S. production, but I don't think it's going to be wholesale, everyone bringing plants over here. It's just not practical. It would take not even years, potentially, decades to really do that. It takes 3 to 5 years to build a plant. So it would just take too long. You may have a new administration at that point. I think it's more on the margins.
New administration, new priorities, possibly. I want to squeeze one last one in. Why is GM outperform and Ford is sector perform?
Yeah, it's also a function of just luck, kind of. GM decided to go into EVs a little later. They decided to invest in building their own battery capacity, which was a genius move. That's the one part of the IRA that's very much intact, so the government subsidizes building your own batteries. I think Ford started with EVs a little too early. Pickup trucks didn't really do as well with the Lightning. The Mach-E went right against the Model Y, and now you're having the GM EV train pick up. Now it's a good time. We have charging infrastructure, et cetera. Also, GM is 60-70% market share in large SUVs. It's like the bread and butter of the American auto system. They're not really, the China exposure, it isn't that big of a threat. And I think if there's a deal, which I think there will be a deal on tariffs, GM is the bigger beneficiary. They have a ton of Mexico exposure, ton of Korea exposure. So it also has more to do with how they benefit from tariff deal being made. Oh, and they're doing a ton of capital return. Ford really isn't doing as much of that.
Tom, as always, you make your case very clearly, convincingly. Thank you, sir.
You got it.
Appreciate it. While we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.